Hello, and welcome to Global Finance Desk. We'll explore practical ideas to help you. I'm glad you're here. Let's learn together.
Most people assume markets rise because the economy is healthy. That sounds logical until you notice something strange. A company announces layoffs. The stock goes up. Consumer confidence falls. The market barely reacts. Homes become less affordable. Groceries become more expensive. People delay vacations. Credit card balances reach new highs. And somehow, the stock market keeps climbing. It's almost as if it's watching a completely different world. That isn't a conspiracy. It's something far more interesting.
Because the stock market doesn't live in today's economy. It lives in tomorrow's expectations. And once you understand that, you stop seeing the market as a mirror. You begin seeing it as a forecasting machine. Think of the economy as a city. Every day, millions of people walk through its streets. They go to work, pay rent, buy groceries, fill their cars with fuel, cancel subscriptions, postpone purchases. Everything they do creates today's reality. Now, imagine another city floating quietly above it, invisible, disconnected from traffic, unaffected by crowded supermarkets. In that city, people aren't trading today's conditions. They're constantly negotiating tomorrow. That invisible city is the stock market.
Every share price is less about what a company earned yesterday and more about what investors believe it might earn years from now, which creates a strange situation. The economy can be slowing down while stock prices move higher, not because nothing is wrong, but because markets have already moved on to the next chapter. This feels unnatural because our brains aren't built that way. We experience life in the present. Rent is due now. Bills arrive now. Interest rates affect today's mortgage payment. Inflation changes today's grocery receipt. Our minds naturally assume today's pain should immediately appear everywhere else. Psychologists call this recency bias. We instinctively believe whatever is happening right now will continue into the future. The market often does the opposite. It spends every second asking a different question. Not what is happening, but what happens after this. Sometimes those two answers are completely different.
This becomes even clearer during bad news. Imagine a business announcing weaker profits. Most people expect its stock to fall. Sometimes it does. Sometimes it rises. Why? Because investors weren't reacting to the news itself. They were reacting to whether the news was better or worse than what everyone already expects. Expectation quietly controls reality. If investors expected profits to collapse by 50% and profits only fall 30%, that disappointment suddenly becomes good news. Nothing improved. Reality simply turned out less painful than predicted. The market had already priced in something worse. That's one of its strangest rules. Prices don't reward good news. They reward surprises.
This is why headlines can become misleading. News organizations report what already happened. Markets spend every second trying to predict what hasn't happened yet. They're solving two different problems. A recession headline reaches your phone. Investors immediately begin wondering, when will interest rates fall? When will businesses recover? When will consumers start spending again? Before the economy heals, markets often begin moving, not because recovery has arrived, but because investors believe it eventually will. The stock market behaves less like a history book and more like an advance reservation. People aren't paying for today's meal. They're booking a table months before dinner is served. Then there's another force almost nobody notices: money itself. Imagine the global financial system as a network of reservoirs. Cash constantly flows between them, sometimes into savings accounts, sometimes into government bonds, sometimes into real estate, sometimes into stocks. Those flows rarely stop. They simply change direction. When interest rates are high, cash often sits comfortably in safer assets. But the moment investors believe rates might eventually fall, that money begins searching for somewhere else to grow, even before anything officially changes. It's like passengers quietly walking toward the departure gate long before boarding begins. The journey starts before the announcement. The stock market often reflects those movements months ahead of the actual economy. Of course, this doesn't mean markets always get it right. Far from it. History is full of moments when investors became far too optimistic. The dot-com bubble, the housing bubble, periods where excitement detached prices from reality. Forecasting tomorrow is incredibly difficult. Sometimes the market predicts the future remarkably well. Sometimes it predicts a future that never arrives. The important lesson isn't that markets are always correct. It's understanding what game they're actually playing. Because most people believe they're watching a scoreboard. They're really really watching millions of constantly changing forecasts collide with one another every second. This changes how financially thoughtful people interpret headlines. When markets rise during difficult times, they don't immediately assume everything is fixed, nor do they assume markets have become irrational. Instead, they ask a different question. What future are investors trying to price today? That small shift changes everything. Instead of reacting emotionally to every headline, they become curious about expectations. Because expectations move prices long before reality catches up. The invisible city still floats above the streets. Below it,
Welcome to your financial future. Together we can build your fund. Let's track your progress. Subscribe now and let's get started. Just click the button today.